Hello and welcome to Talking Stocks. I'm Gugulethu Cele. Also in studio every week, I'm joined by Peter Armitage and Sean Ashton from Anchor Capital. They are the experts, and together we bring you insightful analysis into JSE-listed companies. Now today we take a look at PSG Group, an investment holding company with a market cap of almost 30 billion rand. In their largest investment being a 28.3% stake in Capitec Bank, it also has a 57% interest in a company making local headlines, Curro Holdings. Good to have you with us both today, gentlemen. Maybe let's pick up on the different segments that actually make up this big piece of a pie called PSG.
So I think the best way to think about PSG is that it's a collection of very entrepreneurial businesses that in their respective industries are gaining a lot of market share. And you're buying that all in one listed entity at a bit of a discount to some of the parts. So that's quite attractive for us. When you look at the pieces, Capitec is the single largest part of the business in terms of value contribution. That's about 43% of the value of PSG. You've then got Curro, which is the private schooling business, at about 20%. And that's a business with roughly 40 schools now that we think can grow to organically at least 80 schools by 2020, I think, is management's target.
Record, right?
And we think that they'll grow ahead of that because there's always opportunities to acquire schools ahead of the internal ability to grow organically. So they'll probably raise capital to grow that further. And then you've got a business called PSG Consult, which is the asset management and financial advice business, as well as Zeda. So all of those assets collectively comprise about 90% of the business. And then you've got PSG's private equity assets where we think management will add a lot of value over time. Because you must remember, a lot of these businesses actually came out of almost embryonic stage where PSG had invested in them at the outset and grown them from a very low base. I mean, Capitec is a great example.
Let's zone into Capitec, especially because just last year we had the crisis with the micro lenders, in particular African-based bank investments reaching that slump where it had to be liquidated there. And many people have raised their concerns about Capitec, but PSG has made it very clear that the model is completely different versus Able.
It's a very different model. So I think, and one of the biggest concerns that we had with African Bank at the outset, just to deal with that very quickly, is that they didn't have access to a retail funding base. It was all wholesale funded driven, which obviously comes with a cost disadvantage, and it's a bit less diversified. From Capitec's perspective, you've got this big retail funding base from the fact that you're banking a lot of your customers. So they have deposits with you that cost a lot less than wholesale funding. And at the same time, you're able to charge those customers transactional fees for using their accounts. Which is a fee income which doesn't require you to write loans to actually generate a return, and those are very important distinguishing factors between Capitec and African Bank. But I think further to that, this business has been far more prudent in how they've provided for loan losses. If you look at something like African Bank, they would have 90 days worth of old loans that they were still trying to work through the system and get call centers to try and collect on. From a provisioning point of view, Capitec, when they write a loan, in day one, they impair about 7 or 8% of that loan, just from a prudency perspective, from a portfolio impairment perspective, because they're expecting to make some losses on it. And after month 3, the whole thing is written off if it's non-paying. So beyond 3 months of non-payment, the loan is impaired in its entirety. So you don't have to manage this very long tail of non-performing loans.
Peter, I want to get your thoughts on Capitec just a little bit further, because when it first got into the market, everyone looked at it as a bank that is trying to reach the lower LSM segment. It definitely has made its way and attractiveness to the middle class income earners as well. But are you seeing the bigger picture with Capitec, with it trying to gain market share in an already very competitive environment here?
Yeah, I think there's one metric that tells you everything. They're gaining 100,000 new clients a month. So that answers your question. I think the big banks sit with old systems. I remember one of the banks I used to work for had 4 old systems. They couldn't integrate it. Very complicated. Capitec started with a blank sheet of paper, chose the best systems, kept it simple, and they offer a completely different banking experience to the big 4 banks that we used to. And I see them as part of their business outside of the lending is a retailer of money. So if you walk into a shopping centre, they've got a retailing mindset and they look after the customer. So a traditional Big Four bank will close their doors at 4 o'clock. Capitec, no, we're retailers. So we actually, it's the same client experience as a Foschini or Trueworths. So I remember walking through my neighbourhood mall the other day, and Capitec's still open at 5:30. Every single other bank is closed. If you want to open a bank account, you go in there with an ID book, a proof of address and a thumbprint, and you've got an account to open in 6 minutes. I went to a bank that I bank with a few months ago to open an account for my daughter, and I signed my signature 43 times. So the world's become mad. Capitec have realized that. They've kept it simple. So they're providing a great service. They started at the lower end of the market. But again, I'm giving you lots of personal anecdote, but that's part of what investment's about. My little nephew at university, all of the university students have Capitec accounts. So they're getting that base coming through. And I think part of the excitement and potential is they haven't even started to offer other products and services to these people. So their credit card will launch, I think, later this year. Yep. They've done a home loan JV with somebody. But I think it's still an operation that's got 20% per annum growth potential for quite some time.
Exactly. So we've touched on the financial services arm, which is Capitec. Looking at education, Curro, private sector education is a big sector in South Africa, and clearly Curro is streams ahead of the rest of the pack, and you might agree here.
And
Sean.
I think that they're filling an unbelievable gap. So you've got your brand name private schools, which can cost 80 to 100,000 rand per,
That's your Crawfords
per pupil.
Yes.
So the very top end schools, and then you've got government, which I would argue is not offering a great service at all. And what Curro has modelled themselves as the old Model C schools, which is still a great quality education, but with a fee entry point that is, it's not quite brand name private schools, but it gives you the private school education standard without all of the frills around it. And they obviously build and construct their schools to a specific model that keeps costs down. So they don't necessarily have vast tracts of land that are unusable or not utilised. And you land up with I think their matric fees are something like 3,500 rand a month. So that's a lot of money, but it's significantly more affordable than brand name private schools, and they're gaining significant traction there. So we think, they've put out a public target of saying 80 schools by 2020. In reality, we think that they'll grow well ahead of that, and I think they've probably got the balance sheet now. And I think the difficulty that the market's had in assessing Curro, and it's done exceptionally well, but I think a lot of people have shied away from investing in Curro simply because the PE multiple on the screen looks crazy. But I think it's important to understand that a school, much like a hotel, goes through a J-curve effect where as you build a new facility, you're incurring all the costs up front, and in many instances you've got the costs of the teachers and the infrastructure from day one, but you don't necessarily have a full school. And that results in losses initially. So when you look at Curro's financial statements, you've got a tranche of very profitable schools, the ones that have been around for 10 years or more. And then you've got some what I would call developmental schools, which are coming up the curve. And those ones will be loss-making. So you have a very tight profitability and a high multiple on that earnings base, but you're creating value as you're building these schools. Because eventually, when they are mature and they're full, they'll make 30, 40, 50% EBITDA margins. And the value clearly is being created whilst you burn through that cash initially.
And 90% of new customers, they sign on and you basically got a debit order from them for the next 15 years.
Sure.
So that's a fantastic business. I view it a bit like a property company, just going along with what Sean's saying, is you can buy a property company which will give you kind of a 7-8% yield. Then in the same sort of vein, there's hotels, there's hospitals, and there's schools. And ultimately, all that they're doing is they're putting a piece of property in place. The hotel's getting money from visitors to the hotel. A hospital's getting people who are sick. And an education company is getting students. And the return that you get on your spend in property and education is twice what you'll get in a normal property. So you've got the stable business that's got an asset with a return of double the property return.
So it's a very CapEx intensive initiative right now, clearly.
And I think it's important to reiterate what Pete said earlier. It's hard to find a business model with more certainty of earnings, because if you think about it as a parent, if your child is happy at school and everything's kind of working, you're not going to take that child out of that school until they've matriculated. So The school literally has a very high degree of certainty that once a child is enrolled, they've got cash flows for 10, 15 years, and predictably so. And we know that school fees don't rise at 5% per annum, they rise at 10% per annum. So great pricing power, great certainty of cash flows. It's an excellent business.
Excellent business. Well, let's get a snippet of an interview that I recently did with PSG Group CEO Piet Mouton a short while ago. Now, that was before Curro was making the headlines, and this is what he had to say about the ongoing investment from PSG as a whole into both Capitec and Curro's potential. Let's take a look at this interview.
Capitec obviously came out with great results, and we just want to compliment management on the way they've run the company on the conservative basis over the past 10 years, because as we've seen many of their competitors actually falling by the wayside and experiencing massive problems, and Capitec have proven that they a considerably different business with their earnings up 21%. And then I mean, if we look at Curro, it's definitely one of the businesses that if they do come to us for more capital, we would always invest. It's one of the better businesses that we've seen in the last 20 years.
So quite clearly, Piet Mouton very bullish on those two companies going forward. But it started somewhere with his dad, Yanni Mouton, and that probably brings us to a PSG Consult, where back in the day some controversy took place here.
Yeah, I think so. So Yanni was one of the senior directors of a stockbroking firm, and if you read his book, effectively he got fired.
Yep.
Went off and started his own business. And what he built up, really, the base of it was they've got over 300 offices around the country. They went and either bought or established broking offices in all of the rural towns and built it like that. Today they've built up to a very credible asset and wealth manager, a guy called Francois Gous, who a South African who went over, is one of the top 5 guys in UBS globally. He's come back to run it. An old friend of Yanni's. He was in fact with him in that initial stockbroking firm. But a lot of energy, good business, great client base. And yeah, I mean, our business that we run competes with them, and we respect them greatly.
Exactly. Well, I want us to get into not only PSG further, but also the agricultural business in a moment or two. But overall, from what I'm figuring out, it seems as though the experts are liking the stock. But let's get their overview with regard to buy, hold, or sell. Sean, I think I know where you're going with regard to the PSG as a whole, but your view, buy, hold, or sell?
Definitely a buy.
Definitely a buy. We like the existing stuff. They've also got that little box of tricks, a lot of other private equity companies. And I think the objective is to find another Capitec or Curro or PSG Consult in that, to give them that kind of next leg of growth. But you only have to worry about the next leg of growth in a few years' time. What they've got right now will grow fast for quite some time.
Well, that's where we leave it for today, but nice overview regarding PSG. We do have to leave it here for this week, but do catch us again next time where we talk more stocks.